Good morning, everyone. Welcome to our Wednesday morning trading room. I trust you had a good Halloween evening. Ours was not as busy as it has been some years. We actually had treats left over. But don't worry, they won't go to waste. Friends of ours only live a few blocks from us, and they get over 100 kids coming through their neighborhood. And we probably only saw a couple dozen. All right. So here we are after yesterday, still another rather sideways kind of day. This was yesterday's trading. The long, slow grind upwards. The market closes a little bit of a rally through the Asian and the overnight session, but generally speaking, pretty quiet overall. We have a little bit of a gap here to the upside. Oh my gosh. Rod said they had 457 kids in his neighborhood. That's crazy. That's a lot of candy. Oh, Anthony's very bearish today. He's looking for a sell-off. I think you meant to write 67.27. Or, pardon me, 6. Oh, we got an extra 7 in there, Anthony. At any rate, oh, there's an FOMC release today. Thanks for that, Anthony. So we're fairly neutral overall. Here we're getting a couple of sell signals out of the open, and the target, of course, for the number 2 signal is the hard edge of the trading band. That'll bring us down here to the 62, 65, 66, 67 region. Ooh, Anthony's very bearish. He's looking all the way down here, 62.27. That's yesterday's lows, or close to it. All right, so I mentioned the other day when the market encounters the hard edge of the trading band, you should anticipate some sort of reaction. It doesn't mean that the reaction's always going to have a big follow through, rather that there will be a reaction of sorts. And that's what we got going on here. And Richard's asking in the Raptor, which is the hard edge? There are two. Well, they are both hard edges. Many of you will remember the original Raptor only had the one cloud, and one of the Raptor owners discovered he was getting better signals when he incorporated 2 clouds, and we adopted his recommendation. Now, the way he was trading, he was looking primarily for scalps. So he would look at anything that bounced off the hard edge as a scalping opportunity. But here we're getting a hard edge bounce. It's actually signaling as a cloud crossover because the cloud went out of sync a little bit here, came back into sync, had a teeny tiny pullback, and went with trend. It's, for me personally, we're only a few minutes into the session, so I would treat any signal with a little bit of extra latitude. So what I mean by that is I would probably take a look at using second push entries on almost all the signals. So here's the number one signal to buy. Here's the number two signal to sell. I think I would be looking at second pushes on all of them. Now the number two signal has a tendency to be a little bit more reliable after a hard edge bounce or after a really, really well-defined topping formation. So we do have a hard edge bounce in this number one signal. I suppose you could even bracket just the high and the low of the morning. It's a pretty tight little range. Use an OCO order. If there's an FOMC minute release this afternoon, the market could be pretty dull today. Dan's asking, why do I get different signals than you do? Well, it doesn't necessarily mean that yours is wrong, Dan. Rather that our data may be ever so slightly different. What you can do is you can try this. You can right-click on your chart. You can reload your Ninja. So down here to F5. Do not do this if you have a trade in play, because it's going to reboot your trade manager. It will not close an open position, but it will make it disappear off your chart, which can be a little bit annoying. And as far as my data goes, here on the data series, I have 10 days loaded, and I'm using the default 24/5 template. The signal generation, sometimes if you load, it shouldn't matter so much if you load more days, but if you're on the 24/7 template, it may incorporate a little bit of extra data. Oh, okay. Dan says, I've got the number two signals, but not the number one. I got a number three there. I'm actually surprised this. Oh, see, mine reprinted. I was going to say, I was actually surprised that printed as a number one, because I would have classified it as a hard edge bounce. Either that or my glasses need a stronger prescription. Okay, big bear break to the short side, back into the other hard edge. Now, a lot of times when we produce these number two signals, the market actually ignores the first hard edge. and it just goes straight on through to the second one. That's why the second one tends to be the profit target. But we've had a little bit of a bear break now, and we'll see if we get a follow-up signal. Here's the first macro cross signal on the hawk, and of course we're into the hard edge here on the eagle as well. So if the signals are turning over, we're getting some conflicting signals now, and I'm going to look at this first macro cross. I'm going to enter below the low, cover above the high. Oops, I don't want to take two on that. Still a little early in the day. And there's a little pullback now, so I'll adjust my trade accordingly. All right, so that, the first macro cross lower. Let's see if we're getting a signal here on the Raptor. Not yet, but you could interpret this as a very early trend change signal. The proper cloud crossover isn't going to develop for a while yet, but that's okay. Got the hawk trade going on here, and that will be enough to start. I don't want to get too heavy on a counter trend type trade or a possible trend change. Falcon getting a little bit more bearish now as well, working a possible trend change. The eagle still full on bullish though. Yeah, Dan, you were right all along. Dan says, oh, so I was right all along. Yes, you were. Steve is asking, I think you're asking, your extreme retest is changed to 1.25, not the default value. And yes, that is correct. So that's why I'm printing maybe a few more number 2 signals here. So if you go to your indicator window and you go to your Raptor 2.0, and you pull down here to your signal parameters SE, the extreme retest I have set at 1.25. The default is 1.01. The higher this value, the more number 2 signals you will print. Now, you could interpret this as a very, very early cloud crossover if you were looking for a reason to get into a trade. But as I mentioned, the clouds have not crossed yet. They'll probably need a few more minutes here to actually cross over completely. The Falcon working its trend change signal. So it's gone from a very, very temporary bullish trend back now to a red trend line. There's the pullback after the trend line changes color. Here's the new trend, and all the signal parameters are met, and we produce a signal. But look at the volume on these bars. The volume is so light, 345. Not a lot of trading going on here at the moment. The hawk back into yellow bars, as is the Raptor. Here comes that hard edge bounce now on the Raptor. So still just very neutral overall. If you ignore the overnight, this may turn out to be a test to the extreme of the day session, essentially giving us like a triple top now. We'll see whether or not that moves the market lower again. Good support off the hard edge. If you're looking at a second push opportunity on this signal, there it is right there. So there's an opportunity to buy. And I wouldn't be surprised to see the buyers trying to run it up here to the high of the morning, maybe even higher. So far, we're still a little bit dulled. All right, here we go. Here come the sellers. They're going to maybe check out the bottom end of the trading range. Maybe. Still no momentum. I could roll my stops in slightly. I could start to bring them in above these highs here. Yeah, Steve asking, are you still in the hawk trade? I am. As many of you will have already noticed, I try to give the trade as much room as possible to start. I hate getting stopped out prematurely, only to watch the market turn on its heels and head in the intended direction. I should actually bring my break even. I'll bring my break even below the low of the morning. Okay, and maybe now I'll move into the parabolics. Sure, let's do parabolics. Ooh, making some nice little gains there on that break through the low. Come on, one more push. Good question. Marlene is asking, why did you not go all in, all out? After all my preaching about going all in, all out on a trade, you're always going to be safer going all in, all out. There's always, like on the first micro macro cross. So let's take a look here. Stop it. So on the first micro macro cross, we have a $50 target. This is on the Hawk Scalper. There is a very high probability of success, like better than 80% chance that this trade will work out. And it took a while, but it eventually came down and hit my high probability target. I know that the most market momentum tends to occur within the first hour of trading. That's why sometimes an early trade, I'll try to run it out. Sometimes it'll work in my favor, sometimes I'll just get tagged at break even. But if I'm going to try a runner, it's going to be early in the day. Today it worked out in my favor. Other times the market would have done this. It would have come down here. It would have broken the low. My stops would have hit the break-even trigger. Oops, sorry, wrong button. My stops would have hit the break-even trigger and gone up to here. The market would have hiccuped because of the break in the low. It would have stopped me out, and then it would have gone lower. without me, or maybe a little bit lower, or maybe even just continued higher. That would have been an instance where I would have done much better just taking my profit on target. It also has to do with your psychology. I've worked with all kinds of traders over the years. Some traders are perfectly content just taking their profit on target, and they're happy with that. I tend to usually fall in that camp. It doesn't bother me to take profit here, get my $50, and then watch the market move on without me. That does not bother me in the least. However, I know a lot of traders, it drives them crazy to see the market move on without them. So I think it's a balance of the two, Marlene. I took a chance. It paid off for me this time. I got a little bit extra out of the trade. But when in doubt, go all in, all out. Look at that, a little poetry for you this morning. Your objective as a trader, of course, is to make money consistently. And going all in, all out on target is a good way to do that. Way to go, Frank. Frank says, awesome trade, another one and done. It's nice when you can catch a little momentum. It makes life so much easier as a trader. So if I were looking for my $100 a day objective, I would have just made it. I've made my money. We're half hour into the day. My day is finished. Because, you know, again, and this is where a lot of people lose their focus. They think, oh, well, $100, I can't make a living on $100. Well, yes, you can. You just need more capital behind you. Everybody tries to find more trades, and that's all well and good, but every time you dip your toe in the water, there's a chance the trade may not work out. And that's very annoying. But a great question. Thanks for asking that, Marlene. Yeah, good for you. Anthony says, I'm done for today. Good job. Prasant is asking, hey, Eric, just came back. What was the trade I just missed? Can you please show it again? Absolutely. Tried to take advantage of this first micro-macro cross signal here on the Hawk. The Falcon hadn't, or pardon me, the Raptor hadn't put together a signal just yet, so I went with the Hawk signal. And because the market was rather sideways, I started with my stop back here. I wasn't really sure about the market conditions, so I only took a single contract on it. And it brought me in, it bounced around a little bit. Oh, I also did attempt to run the trade out because I was looking for some of that early momentum. So the market came down, broke the lows, trapped a few traders, got a little bit of follow through, and I got tagged here on this little bit of a reverse. And it looks like it was just as well as we're kind of bouncing around here again. Lost some of that momentum on the move down, but we are retesting this 62, 67 old support zone. It does seem to be acting as resistance now, so we'll see if that holds the market down or not. All right, Steve just had a little bit of a problem here on his Falcon trade. He said I took the late filter signal here on the Falcon, but I lost on it. All right, so I have a feeling, Steve, your stops were a little bit too tight. Stop placement really is not as subjective as most people think it is. Most people think, oh, well, I can just place my stop anywhere, right? And the tendency for most people is to place their stop right here. The tendency is to place their stop right there because they think, oh, well, I'm risking less money. I need to contain this part here. Everybody says you got to manage your risk. Cut your losses short, let your profits run, and all that kind of stuff, which is good advice, but nobody tells you how to do it. There is such a thing as a proper stop. If you can't identify the proper stop, try to remember this. Try to stay 2 swings back. The market will always retest the first swing, but if it tries to retest 2 swings, then you can certainly say that you're on the wrong side of a trade. So this would be swing number 1. This would be swing number 2. Now, this swing here at 62.75 is very close to this swing at 62.76, which is very close to this swing at 62.77. I recommend you always err on the side of caution. So rather than just say, oh, okay, well, Eric says 2 swings back, this is swing number 2, this is where I'm going to place my stop. For the sake of a couple of points or a point and a half, go for the broader stop if you can afford it. Because if you place your stop either above this bar here or above this most recent swing, you have 0 staying power. Or I shouldn't say 0 staying power. The DTS system, for the most part, is very good at picking up immediate market momentum. You'll see that most signals, you'll get the signal, it will print, there's very little pullback, and then the market will move down to its intended profit objective. But that's not always the case, especially on a day where we're anticipating perhaps a major report. So the signal triggers, and I'm suspecting this is where your stop was, because if you're reporting a loss, that's where you likely got tagged. So I would recommend that you try to keep your stop a little bit further back if you can afford it. I would rather sacrifice the quantity of my position for a bigger stop, because the dollar amount will not change, right? If we're using our risk percent mode, it's going to cost the same whether I place my stop here or whether I place my stop up here. What changes, of course, is the profit end. This time I'm only trading 1 contract, and another time I would be trading 4 contracts. So the market comes up, hiccups, bounces around a little bit. See, I'm still in the trade. If I'm getting a little leery on the trade now, and by leery I mean this, I mean, okay, we've had the sellers show up and swing lower. Okay, good. The buyers show up, they try to swing it higher, no success. The sellers try to swing it lower again. Oh, the buyers dig in. At this point, I might be thinking, okay, if the sellers can't hold it together, then maybe I should bring my stop in at least to here. So now if the trade doesn't work out, I've actually got a little bit more structure behind it. So if the trade doesn't work out, instead of losing 365, I've lost half that. I've lost $180 approximately, right? So I'm managing my risk a little bit better. You should always think of your initial risk more like a safety net. You know, if the world comes unstuck, this is what I'm going to lose. And now we're just kind of floundering here a little bit. You may even choose to bring your stop down here now. So now the risk exposure probably sitting at around $100, maybe slightly more. But I'm trying to give the trade every opportunity to work out. Yeah, okay. Steve says, I've listened to your stop philosophy for almost 2 years now, and I get it, but a stop there would take me 4 to 6 winners in a row to recover. So what Steve is saying is, yeah, okay, it's all well and good that I place a stop up here, but if I lose the money, then it's going to take me 4, 5, 6 trades to make up the loss. All right. I get it. It's difficult, I know. First off, your risk should always be contained to an amount you can afford to lose. So that's number one. This amount here should be ideally 5% or less of your trading capital. So that means if you're trading a smaller account, let's say you're trading a $10,000 account, your risk exposure should never be more than $500 at any one time, and ideally around $200. I have no idea how much capital anybody is trading here, but I'm just saying the smaller your capital, you're going to be a little bit more lopsided. You're going to be closer to that 5% than you are to that ideal 1 or 2% risk exposure. The trade-off is that you're going to improve the probability that your trade works out. Trading is always about probabilities. Maybe this is why so many traders, you know, you've all heard the stat that 90% of traders lose money. It's because maybe 90% of the people don't understand probabilities. Probabilities is a give and take. If I give a broader stop, or what I like to refer to as a proper stop, I get a higher probability of success. I'll say that again. If I give more of my money as a probable stop out, in return, I get a higher probability of success. There is a much higher probability of that the market will hit my profit objective here before it hits my stop loss. Right? My stop loss is much further away. It's going to take a lot for the market to beeline up here, hit my stop, without giving me at least one chance to adjust my trade. Now, it has happened. It doesn't happen often. Touch wood. I think the last time it happened was almost a year ago, or maybe in the spring sometime. It can happen. That's why I say think of this as a safety net. This is your worst case scenario. You need to be okay with that amount. But the chances of it happening are very remote. Chances are if the market moves against me, I'll get at least one opportunity to adjust my trade. But if I get stopped out before that happens, then I'll never have a chance to realize my profit objective, will I? if I offer very little on the risk side. Let's say I'm going to go into manual mode now because I really don't want to lose any money, and I place my stop. We'll use the extreme scenario. I'm going to place my stop right there. It's the give and take again. If I give very little on the risk side, I get a very low probability of success. The tighter I make this, I know a fellow who will routinely trade a market like this, and he'll trade like a $25 or $30 stop loss. That's all he's prepared to take as a stop. If the market does not begin moving immediately, he will get stopped out. He understands that by giving very little on the risk side, he's going to get a very low probability of success. But he's okay with that. He's okay getting stopped out. Oh, I've seen him get stopped out 7 times in a day. And I say to him, Tom, why would you get stopped out 7 times in a day? Commissions and fees, it's going to cost you $300 in stop outs. Why not run one $300 stop and at least have a better chance that the trade's going to work out? But in his mind, it doesn't work that way. He makes money trading, but I could not trade that way. That would drive me crazy. So a couple of things I think you should try to take away from this. And folks, please, I'm not a guru. I don't have all the answers. I can only tell you from personal experience. You need to take what I'm telling you. This is your money. I'm not trading your money. This is your hard-earned money. It's yours to do with as you please. But there is that probability trade-off with your stops. Keep that in mind. There is such a thing as a proper stop. Keep that in mind. If this amount is not palatable, if you are not prepared to walk away from $350, do not take the trade. Do not do what most people will do and say, oh, well, I'll just place my stop loss right here and that's okay. I'm okay with a $100 loss. All right, well, if you're okay with a $100 loss and a tight stop, remember you're trading probabilities for success, right? You're giving very little. Your probability of success has reduced as well. So don't be upset with yourself if the market reverses and stops you out here. This was your plan. But I do encourage you to try to keep a broader stop to begin with and then adjust it as the trade progresses. I do believe you need a stop loss. Some people will tell you, take the trade to start and then see how it unfolds and then place your stop loss. I don't agree with that. I think because most people are not disciplined enough to do that, to trade initially without a stop loss and then bring one in. What most people will do is, once the market starts moving against them, they panic. They're the deer in the headlights and they don't know what to do with their stops at all. Yeah, see, like Marlene says, it's a tough lesson, but I did that trade and I did the proper stops and it just hit the target. Tough to watch though. Oh yeah, it certainly is. And it's bad enough when you're trading a single. And I'm so glad that Steve asked this, and please, Steve, don't ever think that I'm, berating anybody, or this is a great learning lesson for everyone. you better believe it. When the market is moving against you, and all of a sudden, you know, you're in the red to the tune of $150, it gets uncomfortable. You can squirm in the seat. If you think that's bad, wait until you've got 4 contracts in play or 5 contracts in play. All of a sudden, that $150 is minus 600, minus 750. Like, yeah, okay. That's when you really start to squirm in your seat. The best antidote for that, however, is controlling your risk and knowing this is my worst case scenario. You got to be okay with that. I've used the poker analogy as well. You know, if you ante up, if you're one of the blinds and you put your money in the pot, or you make a bet and you don't like the cards you get, you don't get to take your money out of the pot. You can try, but if your poker buddies are anything like mine, you're not going to get it. It's, like I say, it's all about the probabilities. We're always playing the probabilities, always playing the odds. What's the best way I can set up this trade so that I have the greatest chance of success? One way is to be all in, all out. Another way is to have a proper stop. Dan asked, can you explain how the swing high-low strategy works? It's my favorite. All right. So the swing high-low, it's as the name suggests, it's a swing strategy. I don't know why they didn't give us at least a 1-tick offset, but the tick offset tells you how many ticks it's going to print above or below the last swing high. So now I've set it at 5 ticks offset. Here's 3 ticks offset. The number 5 is the strength of the swing. It tells you how many bars there are before the swing. So the higher this value, the more selective. So by default, it's set at number 5. That means that at this pivot, at this swing point, there are at least 5 bars that are below that high. 1, 2, 3, 4, 5. Yep, okay, all good. So it determines that to be a reasonably strong pivot. If I set this higher, let's say I set it at 10, here's the point where there are 10 bars before the swing. And obviously the opposite would be true if I set it to a swing low. So here's the last swing where the market had 10 bars preceding the swing low. Sometimes it will do this. Let's say you're looking at a buy and you want it to be positioned down here, and for whatever reason the programming is reading it up there. An easy fix is to go to the bar high-low strategy, which is a little bit more sensitive. Change it to the low, and it's going to immediately throw you below the lowest swing, or the highest swing, whatever the case may be. The bar high-low strategy simply counts how many bars back you want to trail your stop. The nice thing about the bar high-low strategy is it will only roll your stop if the market moves in your direction. So if the market is not moving in your direction, let's say this bar prints lower, this current bar, let's say it prints lower, the stop will not roll. So even though 1, 2, 3, 4, 5. This would be the fifth bar back now. It's not automatically going to roll your stop up to here. The market actually has to move in your direction for the stops to roll. So a very effective strategy, and I like it because I can make it really aggressive. If I'm in a trade, oh, I can't, sorry, I can't backtest it. But if I'm in a trade and I have a fair amount of open profit, I can use the bar high low to really get that stop in nice and cozy and take me out on the first sign of any reversal. So by default, I find the default of 5 for the swing high-low to be adequate, and I usually give it a 3-tick offset. I figure if it breaches the swing high by 3 ticks, it's probably time to go. Mark makes a good comment here. He writes, it does get a little disconcerting when you have 4 contracts in play and things move against you. That's why I stick to only trading the high probability setups for the best chance of the trade working out. But it can go the other way sometimes. It's the nature of our business. They don't all work out all the time, but the high probability trades work out more often than not. And that's, you know, that's so true. It's unfortunately, we're not like Judah Toussaint, who never had a losing trade. We're going to get the odd one. But if you pick your battles and you do the best you can to set up the trade, give yourself the best chances all the way around, and hopefully at the end of the day, you still walk away with some money, with some earnings. It is difficult though. There's to place a proper stop, I mean. The counter trend signals, it's always easier. Easier in the sense that we know without a doubt where this stop should go. The stop loss needs to go below the swing low. If the market continues lower, takes out the swing low, I can say with a very high degree of certainty that I am on the wrong side of this trade. If I had a support and resistance line a little bit further away, let's say I had a support and resistance line printing right around here somewhere. Maybe that's a little far. Maybe right around there somewhere. I would probably place my stop below there versus the swing low. Because again, what I'm trying to avoid is I'm trying to avoid the market just having a look on the other side of the swing and then going back the other way without me. There have been times that I've had to leave the room in a trade. So let's say I took the number 2 signal and this is how I had my trade set up and the market's moving against me. There have been times that I have had to walk out of the room or at least step away from the computer so that I don't fidget with the trade and do something that I'm going to regret. But it looks as though the market trickling a little bit lower. It's probably going to be relatively stagnant until the FOMC minutes come out. We did just fill the gap, the morning gap. Richard's asking, how many times does walking away help or hurt? Well, it usually helps because I have the bad habit of tweaking myself out of a perfectly good trade. I've mentioned this on occasion as well, but one thing about trading is you're going to learn a lot about yourself, both good and bad. You're going to learn your tolerances for risk. You're going to learn your tolerances for greed. And I'm not saying greed in the negative sense. It's just we all have our hot buttons, right? There's some people who can be in a trade, you know, have their stop up here somewhere, be in a trade and have, you know, to say $200 in open profit plus another $300 on the risk side, essentially a $500 trade in play, and it doesn't bother them. And then I know other people who can't stand to see the market move against them at all. It just drives them bonkers. That's how you're wired. Right? I know some people who can't stand the thought of losing even $50 or $100. It's painful to them. Okay, that's fine. That's how you are. So that's how you need to trade. You're going to customize the trading to suit you. For me, personally, like I said, I have the very bad habit, and unfortunately, because I trade on a public menu, and these are all recorded, everybody gets to see me do it. You at least get to do it in the privacy of your office or your home. But there have been a lot of times I'll roll my stops too early. So for me personally, by physically getting away, standing up, stepping away from the computer, for me it helps. For someone else it might be different. Okay, here I'm going to demo this trade. We've got a soft edge buy forming, and I've mentioned that very often the number 2 signal, that's a soft edge buy, has a higher probability of success after a number 3 signal. Let's see if that still holds. So we've got a nice little double bottom here. I'm not going to risk it again right at the low. Rather, I'm going to give it a little bit of fudge room. And we have an opportunity at a second push on this signal now. The trend's still down, though. No question about that. And because this is a counter trend trade, the high probability target is the hard edge of the trading band. Dan says, don't do it, I'm on the other side of the trend. If there is a little uptick here, I don't expect it to be very pronounced. But on the larger scale, we may be looking at a bigger retest of the high here, of the morning, that is. So the morning session opening up here, this may develop just into a big sideways trading range also. And this is strictly for demo purposes, folks. I think the market has a better chance of heading lower than it does going higher. Okay, well, the signal actually never engaged. You can see we had the background highlight, so the parameters were there, but it never printed. And there we go. So it looks like they're going to try to press a little bit lower still. The joys of attempting a counter-trend trade. Oh, way to go. Marlene says, I love that late filter entry signal. That's here on the Falcon. So the filter out of sync, back into sync. Trend line never changes color. This trend line actually very flat as well. Which is what we like to see. If the trend line is a little bit flatter. Let's see, has that found its profit objective yet? Oh, almost. There's also going to be days where nothing seems to work. And you need to decide, is it just the way the market is that day, or is it the way my mindset is? I've done it too. Where you walk in and I try really hard not to impose a personal bias on the market, but there's some days you just can't help it. There's been days I thought the market has to go lower, and of course it spends all day going higher. And I'll try every counter trend trade there comes up, and I end up paying for it. Oh, Dan says, yeah, today is like that for me. I decided to call it a day despite a little loss on the day. It happens. So long as they're little losses versus big losses, you'll be all right. I remember early in my trading career, I lost almost $900 on a single session, and I was seriously bent out of shape on that one. I was so mad. But I was mad with myself because I had broken all my trading rules. And that was the lesson I took away from that. It was an expensive lesson. Not as expensive as some. I have met two separate people. One blew a $20,000 account and another blew a $25,000 account in a single day. And while that's not hard to do, it's not easy to do either. Make sure you're in sim mode, but just try to lose as much money as you can. Just, make a game of it. See how much money you can lose while you're in sim mode. It's not that easy to blow 20 grand. You might think it is, but it's not. So for somebody to come along and tell me that they blew up a $20,000 or $25,000 account in a single day, first off, why would you keep trading after you're down 5,000 or 10,000? For goodness sakes, stop trading. All right, well, here comes another attempt at a number 2 signal. This again after another hard edge bounce. This one not close enough to the hard edge, but it's still a continuation signal. Certainly after that number 3 signal. It is starting to look like a little bit of a bottom. We're seeing some retests of the low. We'll see if we get one more higher swing here. One more retest of the low and another swing up. That may be what the buyers are looking for to confirm that it's okay to buy. Yeah, Steve, you're right. You can't win unless you trade. What was it Wayne Gretzky said? You miss 100% of the shots you don't take. And unfortunately, in our business, we never have all the pieces to the puzzle. We make a best estimate as to what the market might do, and then we put our hard-earned money on the line, and we take the trade. And if it works, it works, and if it doesn't, well, then we need to be okay with this amount right here. We need to be okay walking away from that. Because as soon as you hit the submit button, this amount is gone. So think of it that way. Maybe that will help clear your head if you're having trouble with the risk amount. As soon as you hit that submit button and the trade goes live, this amount is no longer yours. It's gone. Back in the internet's infancy, there was a trader who called himself Phantom of the Pits. I don't know why he didn't give his real name, but whatever. And he actually offered some pretty good advice. He was a floor trader. And you can look him up. I do believe his stuff is still online. And his real name has since come up over the years, although I don't remember who he is. But I do remember his number one rule. His number one rule when he took a trade was he assumed that he was wrong on the trade. He never assumed he was right. He always assumed he was on the wrong side of the trade. And I think what he meant by that is, well, like I said, he considered this amount already gone. It helped him manage his trades a little bit better. Now remember, he was a floor trader, so he would be much faster to adjust his position than we will. His number 2 rule was always make the market prove you right. So he would always look for momentum to bring him into a trade. His number 3 rule, which is a tough one to learn, maybe a little easier as a floor trader. His number 3 rule was always add to winning positions. So what he did is he scaled in. Let's say he could afford to trade 3 contracts. So rather than go in 3 contracts initially, he would go in with 1 contract, and then as the market moved in his favor, he would add another contract. If the market kept moving in his favor, he would add his 3rd contract. So he would build his position as the market kept going in his favor. It's a good strategy, but it's difficult to implement, especially for a small position trader, because what it means is that we're holding a lot longer. So let's say we're going to trade this way. We're going to add to our position. So let's say our initial trade looks something like this. Okay, so the market is heading lower, and let's say we see this little, we're going to add on the break of the resistance zone. Okay, so we're going to add another trade here. So now we can bring our stops in, maybe up here. So now we've got 2 contracts in play. The risk amount will be about the same, right? Because we've reduced our risk from up here to here, about the halfway point, but we've added an additional contract. So the risk amount remains constant. You don't want to let the risk get out of control. Oops. But now, you know, the market is just kind of moving sideways. So what he would be looking to do is on the next break, let's say we're adding on breaks of support and resistance zones, this would be the next place that he would add to a position. Now you've got 3 full contracts in place, so you've got to bring your stops in again, and your stops are going to be a little bit bigger. So the risk amount is going to remain the same. Your first contract will be at break even. Your second contract is going to have just a little bit of risk, and then your third contract is going to have all this at risk, right, from your entry to your stop loss. So dollar-wise, you're still floating a $400 risk, but now you have 3 contracts in play. I know it gets a little confusing. That's the way he would do it. For me personally, it makes a little bit more sense because I'm a smaller trader, and because I'm not on the trading floor, I can't adjust my position as quickly as he can. For me, it makes more sense to do something like this. If I can afford 3 contracts, I'll take the trade and I'll take my profit. But floor traders, they enjoy certain luxuries, shall we say, that we don't. All right, so we're getting a little bit of a bullish push now, back to the hard edge of the trading band. Looks like the buyers might be getting a little bit more serious about attempting to rally the market up. It's a very, very tiny retest of the low, but there it is all the same. Back at this swing high here where the market headed lower before. It may just end up really in a sideways drift. Might see a rally back here to the median line, but not looking too terribly bullish at the moment. Here comes another retest. We are still producing warning dots to buy, however. And you could use this next signal kind of as a one of those discretionary signals, kind of the follow-up after the number 2 signal if you were looking for another buying opportunity. Let's see if the buyers can hold it together or not. So far, no. That hard edge is going to be a little bit of a problem. You can see the hawk already turning a little bit bullish. Falcon trying to get bullish. The Raptor also kind of midway toward being a little bit more bullish, but overall, it's still a little bit of a sticky mess. All right, gang. I think we will button up shop here for the morning. If you have any questions, please type away. But the market's going to be dull until the FOMC release this afternoon at 2 p.m. Eastern. If you are still trading at that time, you'll probably get a lot of volatility showing up. Oh, Marlene says I'm still in that late filter trade. It's going to be a little bit dicey because we're getting a little bit late in the morning here, and we're starting to drain some of our momentum. So if you haven't rolled your stops already, you might want to bring them in a little bit. You know, don't jam them in right above the swing high, but depending where you started, might be appropriate to take a little bit of risk out. I suspect there could be one more little swing here by the buyers, and then if the sellers give us another push to the short side, then you can really start to become more aggressive with your stops. The reason being, if the sellers cannot regain the market trend, then it's going to start going the other way. But like I said, we're getting a little bit late in the day. Tomorrow might be a little better. We may see a little bit more volatility because of the FOMC. All right, gang. We'll talk to you tomorrow. Bye for now.